Dark pools, over-the-counter and off-exchange trading literally destroy the stock market. Today I want to talk about how these different forms of trading cause inefficiencies, how they harbour crime, and how they literally cause the stock market to fail. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, first I want to go through this tweet thread from the CEO of Binance. Now you may say, Tom, that relates to the crypto market, but it's also very, very applicable to the US stock market itself. He tweeted saying, from our interactions, some countries want a segregated order book or segregated liquidity, very similar to a separate exchange. Now with the stock market, we've got the New York Stock Exchange, we've got the NASDAQ, but we've also got Citadel's dark pool, Susquehanna's dark pool, Goldman Sachs's dark pool, JP Morgan's dark pool, we've got over-the-counter trading, and we've got off-book or off-exchange trading entirely. This is where two parties, maybe it's Susquehanna and maybe it's Bank of America, make a trade without posting the trade through the stock exchange or even through a dark pool or even somebody else's dark pool. They literally just make a hand-in-hand exchange that doesn't go through FINRA and doesn't get reported. And the CEO of Binance says this is a bad idea for a number of reasons. He said large liquidity is one of the best customer protection mechanisms. He said it protects against market manipulation, volatility, and reduces liquidations. So the CEO of Binance is basically saying one stock market is the most efficient way to run the stock market. Anymore, and it's inefficient, it causes market manipulations, and it literally destroys the stock market. He said, imagine if we divide the liquidity by 180 countries. It makes it 180 times easier for large traders to swing the market and significantly increase the volatility. aka by saying the more stock markets you have, or the more dark pools, or the more off-exchange and over-the-counter trading you have, it makes it easier for large traders to manipulate the market. He said there will be arbitrage traders trying to bring the prices to balance, but they are not nearly as efficient as one order book, and they make money in between, which is paid for by the consumers. aka these high frequency trading firms try and pick up shares on one exchange or in the dark pool and sell it on the public or in the lit exchanges to generate that money at the expense of us, the retail investor. He says not only these high frequency trading firms making money off your back or off our back, but it's also not nearly as efficient as just having one order book or just having one stock exchange with no dark pools. He said another misunderstanding people sometimes have is that on one exchange, users don't choose a counterparty. They just trade within the order book. You can think of the order book as a broker. He said large liquidity offers better prices for users, tighter spreads, lower slippage, and this is also a very important form of consumer protection and gives a real financial impact for users. Now this is the main problem of having multiple different stock exchanges, dark pools, over-the-counter trading and off-book or off-exchange trading. It makes it less efficient, makes it easier for them to manipulate the market, and not only that, but they can also hide their trades and not report them. And on top of this, the average ape tweeted about the secondary stock market. He said the secondary stock market where investors trade can further be divided into auction and dealer markets. He said most derivatives are based on one of those four types of assets: foreign exchange, interest rate, debt securities, commodities, and equities. It says derivatives have become an effective tool to reduce business risk, but at the same time, those same derivatives like total return swaps have also been created to manipulate the market further. It says corporations and financial institutions, aka hedge funds, are the major users of derivatives, and swaps are the major derivative instruments. You've got mortgage-backed securities, collateralized debt obligations, and loan obligations, and those are instruments of securitization. The most common form of credit derivatives are credit default swaps and total return swaps, credit spread options, and credit linked notes. Now obviously these forms of instruments aren't traded in the stock market or even in the dark pools. They're traded over the counter and entirely off book and off exchange. But effectively the trading of these sketchy derivative products is exactly the problem that destroys the stock market and causes it to be inefficient and makes market manipulation significantly easier. Because these derivatives are traded off exchange and don't get reported to FINRA, these hedge funds can accumulate massive amounts of total return swaps without anybody else knowing. And as the tattooed ape tweeted, she said this is not a grey area. This is 100% market manipulation fraud. And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 10 free stocks worth up to a total of a whopping $25,000. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not sell your order flow, and therefore Moomoo is brilliant for buying those AMC and GameStop shares. She said you cannot run retail shares off exchange, that's for institutional orders, yet still already 13.5 million AMC shares have been ran through the dark pool, stealing $209 million worth of buying pressure. We know the majority of AMC trading is performed off exchange in the dark pools through multiple different dark pools, and very few trades actually go through the lit exchange, through the New York Stock Exchange, through IEX, through the NASDAQ, or through other lit exchanges. But the fact we have 12 different exchanges here just for the known volume of AMC trading, plus all of the other dark pools included within this off-exchange amount, and all of the other over-the-counter trading and off-exchange and off-book trading as well, shows just how inefficient the current market is. The fact we have multiple different stock markets and dark pools and over-the-counter trading means it's easier to counterfeit shares, makes it easy to manipulate global financial markets, causes high treason and fraud, and also bankrupts innovative companies into the ground. But fortunately, the Infinite Liquidity Machine tweeted saying on AMC, after talking to people who know the markets inside and out, I'm left with the impression that the last thing the market makers on AMC want is a split from common to preferred stock. As I said in my previous video, it's very easy to incorrectly split AMC shares into more AMC shares, but very difficult to fake an AMC stock split via dividend in an entirely separate stock. This is the last thing these market makers, trading platforms and exchanges want, because they simply can't fake or accidentally, incorrectly split the stock via a stock split instead of via a dividend. He said, let's say for example, AMC has twice the free float in synthetics. He said, I don't know this to be true, but swaps data would say it has to be significant. He said, so you've got 1 billion shares that must be created out of thin air to fulfill the ape offering to all AMC holders. And he said a conversion of stock class from preferred to common can literally be done in a matter of days. He said, can you imagine you're the market makers and you get the call saying you've got 3 days to find all of the shares you made from nothing? Obviously the AMC stock split via dividend must be issued at the same day, but these hedge funds won't be able to create billions of synthetic ape shares before they've even been delivered. And he said that is your pounce, and from August 22nd onwards the threat is there, and on top of that the T+35 date for the GameStop split dividend is also the following week as well. So these market makers are going to have to find billions of ape shares that don't even exist yet and fulfill the T+35 delivery of the GameStop split dividend, all effectively within the same week. And this is exactly why multiple exchanges and dark pools destroy the stock market. Without these dark pools or this off-exchange trading, none of these synthetic shares would have ever been created. AMC would never have been pushed to the brink of bankruptcy by synthetic shorting, and these hedge funds wouldn't be stuck in a bankruptcy loop, again without those synthetic shares. Yes, Ken Griffin and Citadel would have seen some smaller profits over the years, and Ken would have seen some smaller bonuses over the years, as he wouldn't have been able to naked short companies illegally, but the stock market would actually work. I think it's so easy to see when multiple different exchanges does work for these hedge funds and when it doesn't. This post on Reddit says $13 and change to $2,500 per share, but yet it didn't cause any systemic risk to the market. He said nobody freaked out about HKD, Robinhood and any other brokers didn't turn off the buy button, and clearing firms and hedge funds didn't need to be bailed out or didn't need to have those margin calls waived. No buy button was taken away to protect clients from risk, and no trading platforms like Robinhood freaked out and failed margin requirements. And that's likely because these trading platforms and these market makers were causing the pump, likely the ones responsible for it, and they were benefiting from it, generating additional cash to meet their current margin calls. As you can see, GameStop climbed from $21 per share to $400, and the buy button was removed because the systems couldn't handle it, and it almost crashed the entire stock market. But when HKD climbed from $13.50 to $942 and above, a 5,000% climb, there was no buy button removed, nobody freaked out, and there was no issues. You may say, Tom, that's completely different because GameStop was much, much larger. But actually that couldn't be farther from the truth. At GameStop's peak, it only had a market cap, or a known market cap, of around $50 billion, not including synthetics. But yet HKD ran over $300 billion and therefore at its peak was 6 times larger than GameStop. But yet GameStop, 6 times smaller than HKD, caused 10 times as many issues and almost crashed the entire market, which I think just proves that there are indeed billions of synthetic shares out there for GameStop and AMC and for the other meme stocks as well. And as a result, the SEC has indeed been probing Robinhood Markets' compliance with short selling rules since October. So far as Batman said, all talk and no enforcement so far, which is absolutely true. But it does show the SEC is at least doing something probing Robinhood and their compliance with short selling rules for some time now. I'm sure it's all going to end up in lip service because obviously Gary Gensler, the SEC and these other acronymed agencies are all paid off by these hedge funds. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.